gentlemen, welcome to the fabulous Balboa Resort for our 2024 Economic and Financial Forecast Luncheon. Please welcome President and CEO of the Newport Beach Chamber of Commerce, Steve Rosansky.
Okay, let's get started. Welcome to the Newport Beach Chamber of Commerce and the UCI Paul Merage School of Business 2024 Economic Forecast and Financial Forecast Luncheon. We have an exciting program for you today as we take a look at the economic forecast for 2024, right around the corner. And we're going to drill down on the forces driving the commercial and real estate markets. It's been a year since we last convened here at the Balboa Bay Resort, and the economy continues to confound us. Last October, a Reuters poll of economists, I don't know, there's a lot of economists, they have a lot of opinions, but 65% of them believed that the U.S. economy was headed into recession in 2023. Not only do we not see a downturn in 2023, GDP has increased at a steady pace of just over 2% year over year. At this time last year, the stock market was headed into bear market territory. However, the S&P is up 20% year over year, the Dow 15%, and the NASDAQ a whopping 28%. After 5 hikes in the federal funds rate by last October, the Fed raised rates 6 more times in the past year, increasing from 3% to 5.25%, a 75% increase in the Fed funds rate. In the face of 25-year highs in home mortgage rates that hover just under 8% currently, rates that we haven't seen, and I was a mortgage broker for many years, haven't seen in 25 years, home prices have managed to remain high as the supply of homes for sale has been anemic. And finally, that bastion of investment, Bitcoin, is up 45% year over year. There you go, Bitcoin. But we're not here to dwell so much on the past as to figure out how we got here and what the future holds. And to that regard, we brought you 2 experts in their respective fields. First, Christopher Schwartz. He's a professor of finance at the Paul Merage School of Business and the faculty director for the Center of Investment and Wealth Management at UC Irvine Paul Merage School of Business. Second speaker today will be Marshall Toplansky. I met Marshall about a year ago or so at a meeting actually in Corona Del Mar, and I was impressed with what he had to say, and I said, we got to get him back here. He's the innovation professor at the Argyris School of Business and Economics at Chapman University, and the co-founder and former managing director of KPMG's National Center of Excellence in Data and Analytics. He's also the director of the Harvard Business School Association of Orange County. So please feel free to be eating your lunch while I take a few moments to recognize some of the VIPs that are joining us at the forecast this morning. With us today is City Councilman Brad Avery, somewhere. City Councilwoman Robin Grant. City Councilman Joe Stapleton. City Councilman Eric Weigand. Newport Beach Planning Commissioner Mark Rosine. Our City Manager Grace Leung. Former city manager and a good friend of mine, Homer Bludow. City Attorney Aaron Harp. Our Fire Chief, Jeff Boyles. Our Assistant City Managers, Simone Jurgis and Tara Finnegan. State Senator Josh Newman, I think, is joining us, maybe. Is he? Okay, good. Josh, here somewhere. Our Orange County Supervisor, Katrina Foley. Costa Mesa Mayor John Stevens. From the Newport Mesa School Board, we have Michelle Bartow and Leah Ursulou. Former Assemblyman Matt Harper. I saw him here with his fedora. There he is, back there. Dean of the Paul Merage School of Business, Ian Williamson. President of Newport Beach and Company and a good friend of mine, Gary Sherwin. President and CEO of the Boys and Girls Club of Central Orange Coast, Robert Santana. That's it. As expected at an event like this, it can only occur with significant support of some very special sponsors. So please let me present our 2024 forecast sponsors. First up is ACI Jet. ACI Jet's here somewhere. The Epic Times, Pacific Life, Julie Lawton Design Build, Shop Off Realty and Investments, Spinnaker Investment Group. Our silver sponsors, first time out, Bridgeford, David Warren. Our supporting sponsors, Apollonian Accounting and Business Services. Yeah, they have three tables here today. Thank you. Orange County Supervisor Katrina Foley, just mentioned her. The UCI Paul Merage School of Business, the UCI Merage Center for Investment and Wealth Management, and Chapman University Argyros College of Business and Economics. And of course, I want to thank our event hosts here today and all the staff. Steve Arnold, I thought I saw your name on the list. He's running this place now. The Balboa Bay Resort and the Newport Beach Chamber of Commerce. We did something special this year that we haven't done in the past. I sent it out to a number of chambers around the county to co-partner with us on this event, and a few of them took me up on my offer. So I'll just quickly run through them. You don't need to applause for everyone, but maybe at the end. Chambers, Laguna Hills, Santa Ana, Placentia, Laguna Beach, Lake Forest, Costa Mesa, Dana Point, and the South Coast Metro Alliance are all co-partners with us on this event today. So thank you all of those chambers that agreed to participate. I'd also like to thank our table sponsors. They're listed in your program, and recognize our Chambers Leadership Circle members who support us year-round, and we couldn't do an event like this without them. So I'm going to go through them quickly here because we got a bunch of them actually. Platinum members, Balboa Bay Resort, Southern California Edison, Apollonian Accounting and Business Services, ACI Jet, Simple Green, City of Hope Orange County, Vea Newport Beach, a Marriott Resort and Spa, Orange County, yeah, Debbie's here. Orange County, do you have that hotel saved for me to make sure I get it? For Scott, okay. Vea, we said that one. Orange County Supervisor Katrina Foley, Newport Beach and Company, Hogue, Julie Lawton Design Build, Davies Locker Whale Watching and Sport Fishing. Thank you, Davies Locker. They're also a big sponsor of our boat parade. Gold members, Newport Beach Association of Realtors, VK Suites, the UCI and UCI Health System, West Coast Arborists, and the Newport Beach Police Association. And of course, all of our silver level leadership members, they're listed on your screen, also on the back of your program. Thank you all for supporting our programs year-round. Before we break for lunch here, I do want to invite Supervisor Katrina Foley up to the podium here. She has a special presentation for our chamber. And so she's going to make her way up here. Hope everybody's enjoying their lunch.
Good afternoon, everyone. I'm Katrina Foley, your County Supervisor, representing the 5th District. It's Costa Mesa all the way to San Clemente. It's the fabulous 5th District. And I'm looking forward to the presentation today. We had an update on our sales tax revenue that's being generated here in Orange County at our Orange County Transportation Authority this week. And we have record high numbers of sales tax dollars coming into Orange County. 96% of all of our businesses here in the county are family-owned small businesses. So thank you all for driving our economy here. And as your county supervisor, I think it's very important to invest in our chambers and our small businesses, workforce development. So to that end, I have donated a grant in the amount of $100,000 to the Newport Beach Chamber to support your workforce development and your local businesses. Thanks, everyone.
Got to figure out where to endorse it, right? Okay, thank you, Katrina. That was very generous of you. I know she's supported other chambers and other organizations throughout the county with some of the funds that the county received, and we appreciate that, and we'll put it to good use. We're already putting it to good use. So please continue enjoying your lunch, and we're going to take a short break here, and then we'll be back with our program in a few minutes. Thank you. So welcome back. Welcome back, everybody. I hope you enjoyed your lunch. I think most people are finishing up and they're setting the dessert down, so feel free to continue eating, but we need to get our program going so we can get you out of here on time. Before I introduce our two speakers, I would like to mention that we're also joined today by Assemblywoman Diane Dixon. Diane, doing a great job for our district. And also, we've been joined by my boss, actually, and I'm probably going to get fired for not introducing him earlier, but the chairman of our board, Andy Smith. Andy, thank you for coming. So anyway, as I mentioned earlier, we have our two featured speakers today, Chris Schwartz, Director of the Center of Investment and Wealth Management at the UCI Paul Merage School of Business, and Marshall Toplansky, the Innovation Professor, Management Sciences at the Ardress School of Business and Economics at Chapman University. So Chris and Marshall, why don't you join me on stage, and we'll get going here. I see, did we lose Marshall? He's not, oh, he's in the restroom. Okay, well, good thing he's the second speaker. Chris is young, he can hold his water. Oh, there's Marshall. Okay.
Keeping it classy, Steve.
Yeah, I know, you know, hey. I saw your slides.
Yeah, exactly.
So we're going to have Chris and Marshall make their presentations first, and at the end we're going to entertain some questions from the audience. So please, if you have a burning question, remember it, and we'll try and get to you at that point. So let's start off with Christopher Schwartz is a professor of finance at UCI Irvine's Paul Merage School of Business, as well as the faculty director for the Center of Investment and Wealth Management. During his time at UCI, he has been published in all the leading academic journals and practitioner finance journals. His research has also been cited by the New York Times, the LA Times, Wall Street Journal, and the Financial Times. Prior to arriving at UCI, Christopher received his PhD from the University of Massachusetts Amherst, during which he was also a visiting doctoral fellow at Yale University's International Center of Finance. He's also actually a visiting professor, I think, at Columbia this year. So he actually flew in this morning for our event. Last up here, he also received his Bachelor of Science degree from Babson College in Wellesley, Massachusetts. Please welcome Christopher Schwartz.
Good to see you. All right, how's everybody doing? Good? Hey, feeling good? All right. So we go ahead and get started. I saw that these seats are new if you're here before, right? These seats were here. I thought we were gonna have the two old guys from the Muppets up here to heckle me. You know what I appreciate about this crowd? You guys actually know who the Muppets are. So no students to know who the Muppets are. So, all right, so as Steve mentioned, pretty much every economist last year, including yours truly, had a prediction that the economy would do very well this year. And so pretty much every single time a data point came out, we kind of were like Walter White's kid at the last episode. We're like, you asshole, why don't you just die? We need you to die because you're making us all look very, very wrong. Because the Mean Girls review of last year's forecast is basically, oh my gosh, you're wrong. You're so wrong, right? It's been a great year for the economy this year. Actually, third quarter GDP is forecast probably to be the best this year, over 3%. And so the economy's done really, really, really well. So, Steve asked me to come back again, and it took a lot of courage to get up here and come back after you're so wrong. So I went to a lot of therapy, and with some help from the Eternal Spotless Mind, I've kind of erased last year's forecast, and I feel good. I don't remember it, and so I can do the George Costanza up here and say, I'm back, baby, and I'm going to do better this year. But just in case, I want to remind you that I will not be the worst forecaster you see this year. Okay, that would be the weatherman, all right? Because right now, in Cave Creek, it's 2,960 degrees, all right? And surprise, it's 1,350 degrees. So I will not be the worst forecaster you see this year. All right, so, kind of if I'm going to summarize things for the economy this year, the economy is just kind of rolling along. And it will roll along until we kind of have some shock, right? There's going to have to be some shock that kind of takes us out of our current state. What that shock is exactly or when it exactly hits, it's hard to predict, right? All of us economists thought it'd be this year. Maybe it'll be this year coming up. And so I'm going to take a couple guesses at what the shock will be. My guess is the shock will probably be the Fed. It's probably hard to imagine long-term bonds are in a good value here, and we'll talk a little bit about that. And it's tough to be bullish. I'm not bearish on stocks necessarily, but it's probably tough to be a little bit bullish. At least 3,993 of them, which you'll probably understand here in just a few more minutes. All right, so I always like to start with the Fed forecasts. All right, so the Fed forecast last year was that we're going to be at 0.5%. So last year when we were here, the Fed thought we'd grow at 0.5% this year. Of course, the Fed's usually biased high, so if you remove that bias, we're going to be about 0. For next year, they think we're going to be at 1.5%, which is a perfectly reasonable forecast. It's probably average GDP growth that we're going to have for the next 20 years or so. So they're basically forecasting a pretty normal year, right? So they're thinking the economy is going to be pretty good. And why? Why do they think the economy is going to be doing so well? It's because if you ask everybody in this room, and of course we had some great data earlier, if you ask everybody in this room, how much money do you have to spend on clothes, just like Ryan Gosling asked in Crazy Stupid Love? The answer is we have a lot of money, right? Everybody's feeling pretty good about life, right? So if you look at year-over-year growth in personal spending, even after you get rid of the COVID bubble peak where we gave everybody a lot of money, we're actually still spending money at a clip that's the fastest since the housing bubble. Almost the last 20 years, we're still having retail sales and personal outlays that are going faster than they have over the last 20 years, right? So even though this is kind of a mature cycle at this point, we're spending a lot of money, all right? We're not only buying money on just everything, we're buying more cars. So car sales are up a lot this year. So we've had some of those inventory issues go away that we were worried about. And car sales are going up. So if you think about spending, the reason the economy is doing so well is because everyone spends a lot. We all know in this room. Again, I always joke that there's nothing more American than spending money. We're really good at it, and we continue to spend money. All right, and the question is, why do we have so much money? How many people out there on LinkedIn? How many people have a LinkedIn account? I'm assuming everybody. All right, very good. A lot of you are lazy. Thank you for letting everyone else vote. It's okay. All right, I know which one of you guys are going to vote in the presidential election in a couple years. All right, so why do we have so much money? Because if you log into LinkedIn, I have a new position. I have a new position. Oh, I have a new position. No, I have a new position. I have a new position. I have a new position. Everybody's got a new position. All right, how many people in this room have switched jobs in the last 2 years? All right, so you have to triple that based on the number of people that raise their hand about being on LinkedIn, because everybody in the room is on LinkedIn. All right, so here's the question. No one will raise their hand. How many people want to get a new job in the next year? All right, see, no one will raise their hand for that one. So I was hoping a lot of you would raise your hands because we're recording this, and I got 2 little kids I got to save for college. But that blackmail's gone, all right? So the job market's doing great, right? Unemployment is basically hovering around the lowest it's been since World War II. We got 3-something% unemployment. It basically bounces between 3.5 and 3.8. If you look at the number of people employed now, we have 5 million more people. That's not a typo. 5 million more jobs in the United States now than we had pre-COVID. All right? If you look at participation rates of the working age population and percentage of people employed, it's all-time highs. Right? So if you think about the labor market is incredibly strong, and that's why people have lots of new jobs, right? Basically, if you want to get someone at your firm, you have to hire them from somebody else. And if you look at more real-time data like jobless claims, like initial claims or continuing claims, you can see they're hovering down near cycle lows. All right? So the economy is doing great. People have jobs, lots of jobs, all right? And until people don't have jobs, the economy is going to be fine, right? Because people aren't going to stop spending money unless they're worried they're not going to have that job. Now, with that said, job growth is definitely slower than it was 2 years ago. So this is payrolls each month, the number of new jobs in the U.S. The orange lines here is 2021, 2022, so far 2023. So we've gone from 600,000 a month to 400,000 a month down to about 250,000 a month. And that's just because there's less people that we have to pull off the bench and employ. So things are slowing down, but jobs are doing great. As long as people have jobs, they're going to go buy stuff. As long as people go buy stuff, GDP is going to be fine. Right? That's the bottom line. Right? So why is there no recession? Right? So the Fed's been raising rates. We can come up with a million excuses. And really, I think one of the things that we economists got wrong last year is we didn't think about momentum. right? We didn't think about how persistent things are in the economy, right? People aren't going to change their behavior, right, unless there's a reason that they have to change their behavior, right? And so it's going to take some kind of shock to figure out what's going to slow the economy down or make the economy slow down. And so we got to ask Jackie, what is going to make the economy feel shocked and chagrined? All right, what's going to make us mortified and stupefied and stop spending money? I love Jackie. Jackie's great, all right? So I was going to ask ChatGPT, all right, but ChatGPT got a 27 out of 100 on my final, all right? So I wanted there to be some chance I gave you the right answer, all right? So I decided to ask someone who always has the right answer. I asked Captain Obvious. Captain Obvious told me it's going to be the Fed, right? Because Captain Obvious tells you the obvious answer, all right? And you can see he's freaked out. Everyone's freaked out about the Fed, all right? And so the Fed has raised a lot very quickly. So I think I probably showed some version of this graph last year. So the Fed raised rates a few times. Last year, you can see they've kind of plateaued. So just so what you're looking at this graph. So this is at the end here on the left, it says 1. That is when the Fed started raising rates this particular cycle, and then it's the number of months in the future, right? So the farther to the upper left you are, the faster the Fed's been raising rates. And this is all the different cycles that we've had over the last 5 decades, right? And you can see until recently, this is the fastest cycle the Fed's ever raised rates, right? An important thing to note here is when the Fed raises rates, it takes about 12 to 24 months for that rate to actually fully impact the economy, right? So you can see here, we're only at month 18, which means that even the very first raise hasn't completely impacted the economy yet, and all the big raises we had last year, the 50s, et cetera, those really haven't even just started to impact the economy that we have today. All right, so the Fed's been going very quickly. The thing that's really changed this year is that the Fed, people aren't expecting the Fed really to lower rates anytime soon. So this is a forecast for where the Fed funds rate is going to be, what the Fed's going to do over the next year and a half. And you can see these are different points in time. So if you look at the red line there, that was when Silicon Valley Bank failed. People thought the Fed would lower rates very quickly. You see the whole yield curve shift down there, basically. And now you can see we're at the top blue, which means we're at the cycle high. Basically, you've heard this thing, the Fed's going to stay higher for longer or something like that. It sounds like some kind of Home Depot type of slogan that people got. But anyway, we're going to stay high for a long time, and the Fed's not going to lower rates, right? And so the real question that we have to ask ourselves, or if I was to ask Jay, and I'm going to see Jay next week. So I'll ask Jay in person when I see him next week at a conference. I'm going to say, Jay, one is, how much is enough, Jay? Right? How much interest rates is going to be enough? And Jay's probably going to do exactly, he's going to shake his head at me and say, you dumbass. All right? It's never enough. All right? Because ultimately what's going to happen here is the Fed's already beat inflation. Right? So this is my graph of inflation. So left-hand side here, this is regular CPI, the headline number that you see with food and energy and everything else. As I mentioned, if you see me do this before, the middle is used car prices and gas, right? So remember, oil prices were negative. Car prices were going up a lot because everybody wanted a car, because for some reason, no one wanted to ride the subway in New York when everyone was dying of COVID. I don't understand why, right? So people bought a lot of cars. And then if you take the left bars minus the right bars, you ended up on, in the middle bars, you end up on the right, which is kind of what I called like persistent CPI or sticky CPI. That's my version of it. And you can see we peaked a long time ago, and now we've kind of started going down. And we're going to go down farther, right? We've already conquered inflation. Inflation is conquered. Are prices going back to where they were 2 years ago? Of course not, right? But we're talking about the change from now, and the change from now has been conquered. All right, and this number is actually way too high. Inflation in the US is not 3.5% anymore. That's way too high because this is really impacted by shelter, right? So this is impacted by the shelter component. So the shelter component of CPI is 40%, which is basically rents. So I have 2 indices here, one for Zillow and one apartmentlist.com. And you can see here that 2 years ago, they were going up like 20% year over year. And then the gray bar is CPI's measurement of shelter, and you can see that it just peaked. So even though the actual rents, and for people, it peaked 2 years ago in terms of year over year change, the peak in the CPI index just happened a few months ago, right? So really, if you kind of go back in time to where the blue and the orange line were last time they were here, you can see that really shelter and CPI should really only be going up like 2 or 3% year over year. Right? So if you make this really long lag adjustment to CPI, where are we at? CPI would be 1.8%. Right? The Fed targets 2, we're at 1.8. Right? So you can double check my math, all right? But I'm telling you, it's 1.8% if you adjust for where shelter should be. We've conquered inflation. Right? Inflation's conquered. The number that we have is too high, but yet the Fed refuses to think about that. They, in fact, based on that jobs report, they might even think about raising rates here again, right? Which would be kind of crazy. Because it's all about the real rate. All right, it's all about real rates. So what this is the Fed funds rate minus CPI. right? So Fed funds. So this is like if your CD or your account, your savings account, what yield do you get minus inflation. So it's in the red. You are encouraged to go buy stuff, right? Because if you just leave your money, even though you're getting interest, you're losing to inflation, and you'd be better off buying stuff because the next year you can buy less stuff. When it's green, you're encouraged not to spend money because if you leave it in your account, the next year you're going to be able to buy more stuff than you can this year. All right, so we're even before that adjustment. We're at the point now where real yields are positive, right? So you're better off leaving your money in a savings account than going off and spending it because next year, with no risk, you'll be able to buy more stuff than you can today. All right, and so what happens is when this is positive, you're going to be like Hans in Die Hard, right? You want to sit on the beach. And you want to earn your 20%. No, because those are German bearer bonds from 1980s, but the point is the same, right? Which is you don't want to spend money. You want to keep money in the bank, right? And if you keep money in the bank, guess what? You don't spend stuff, the economy gets weakened, right? So right now we have rates that are positive, real rates that are positive. And so really it's kind of at the point here where people are probably going to be motivated to spend. All right, so the Fed's probably your biggest shock. By the way, the things that killed the last two expansions, minus COVID, so the tech bubble bursts, because the Fed raised interest rates a lot, people couldn't get financing, that cut off Silicon Valley, which led the economy to collapse. In 2007, Fed raised a lot. You had rates reset, interest rates are too high. Finally, all those loans came back to roost. So it's probably going to be the same shock that caused the economy. When exactly that becomes binding, I'm not sure, but ultimately it's probably the Fed that's going to cause the next recession. All right? Other possibilities, all right? So, of course, I actually made these slides before what happened in the Middle East happened, but you have global thermonuclear war. So if we have all kinds of war and everything else, then, of course, that's going to have a big impact on the economy. By the way, war is usually a positive for the economy, so this would probably be a positive shock, actually. Although so someone asked me if Russia started nuking Ukraine and Poland, like what would happen to the economy? This is a question I got last year. I was like, I'm thinking you probably don't care about my econ forecast if people are nuking each other. Just guessing. So, but in any case, so war could be a big thing. All right, government chaos, right? So things are kind of a little crazy in Washington, even more crazy than usual, right? Usually I tell you, like when people worry about a shutdown, don't worry about it. Like they'll figure it out. They got really close this time. All right, really close. So I'm going to let you pick. This is like the Hardy Brothers books. If you read those as a kid, this is Pick Your Own Adventure. So you guys can pick who you want to blame individually. All right, so I'm going to be politically agnostic, and I'm just going to pick the boogeyman. All right, so you guys can pick whoever the hell else you want. Dealer's choice. All right, and then I'll go ahead and I'll pick the boogeyman. All right, student loan payment. How many people are student loan payments going to be end of the consumer? All right, nobody raises their hand. That's great. All right, so apparently nobody has student loans. And UCI is so affordable, our students only leave with like $10,000 in average in student loan debt. Right, so good for UCI. All right, but there's $1.8 trillion outstanding. There's 41 million borrowers who are going to have to pay $390 a month. So some quick arithmetic tells you they're going to have to pay $16 billion per month in payments. Consumer spending each month this year has been up over $100 billion. That's like not the level, that's the change. Right, so if you subtract 16 billion from that, it's called rounding error. Right, so these loans probably aren't going to do anything. All right, and it doesn't cover, you have a ramp up and you have, 270-day stuff and all this other stuff you have going on. It's not going to be student loan payments you got to worry about. What about gas prices? Now, I know everybody in here has a Tesla because we all like to hug koala bears, all right? But gas prices are really high, all right? So maybe it's going to be, do we not like koala bears? Is it an Australia thing? By the way, the most ironic thing is if you go to Australia and you order a Foster's, you can't get a Foster's. It's really bizarre. Anyway, it's like how American cars are not made in America, but then German cars are made in America. Anyway, we could go on this all day. All right, so maybe it's gas prices, right? So gas prices are real high, but that's not really a big part of consumer spending. By the way, gas prices are really a California thing, right? So this is the difference between California gas prices and national gas prices. I flew in from Chicago this morning. It's like $3.50 a gallon in Chicago for gas. All right, so I tried to put a drum of oil on as my carry-on this morning. It was too big. They wouldn't let it on, so anyway. All right, one last possibility, maybe ChatGPT. Maybe, generative AI is going to be the thing that's going to be the shock. I think most people would say this is a positive shock, of course, unless it turns into Skynet. All right. By the way, I saw a disturbing, I think Bing had to shut down their AI. If you want to Google Bing AI Mickey Mouse, if you want to be disturbed this morning about where AI goes, you can do it after we're done, of course. Right, Marshall?
Exactly.
Exactly, after we're done.
Exactly.
Marshall's not even paying attention, so if you want to do it now. If you want to do it now, just go ahead. It's all right. I'm a professor, you know, I teach at night. When the NBA is on, I can get the score of a game, but I can't get the answer to one of my questions. All right. So, you know, we're kind of at the end of the cycle, right? I think people can feel, you know, it's hard to get better from here, right? There's probably no way to get better, only ways to go down. There'll be some kind of shock that does it. You know, rates at some point will become binding. I think if you talk to bankers, et cetera, they'd probably agree with that. You know, the ultimate question is, when does it happen, right? And that's tough to predict, and that's the part where I think a lot of economists thought it happened already, but it hasn't. And so the long term, I'm going to talk a little bit more about this in my last few minutes. I have no idea how long I've got. I'm going to just pretend I still have more time. You know, are we going back to where we were prior COVID for the 20 years before? Or are we even going farther back in time, right, in terms of the economy? And I'll show you what I mean by that when we get to the end, and I'll give you my prediction. All right. Stock market. All right, so far this year, Lloyd has had a better chance of picking stocks that have gone up because, you know, at least he had a 1 out of a million chance at picking stocks. Now, you might be shocked by this because the market's up, right? Kind of, sort of, right? The Dow's actually negative for the year right now, right? If you haven't checked lately, it's actually negative for the year, all right? And so, of course, the Reddit people don't care, right? So Bed Bath & Beyond, it's gone beyond, all right? All right, we got AMC's back to where it was prior to COVID. GME's on its way, but the Reddit crowd's like still telling me, there's a chance I'm going to be right? Yeah, there's a chance. All right, not very high. All right, and by the way, Steve, no one cares about Bitcoin anymore. Don't own any. All right. So what am I talking about here? I said the market hasn't done very good this year. All right. So I had to come up with a title. There's always titles, right? So in the 1970s, we had these 50 stocks that drove the market. We called them the Nifty 50, right? And then we had the FANG stocks, all right? Even for countries, you have BRICS. So I was going to call it the Sexy Six, but that's too simple, all right? So I'm going to call it the Seductive Six, right? So it's like sophisticated sexy, all right? So the Seductive Six are Apple, Microsoft, Amazon, Tesla, NVIDIA, and Google, right? Those are the 6 biggest companies in the world. All right, so what you have here in blue is you have the percentage of the S&P return that comes from those 6 companies, right? So this is their return multiplied by their weight and the S&P 500 added together, right? So if you take the S&P and subtract this amount, this is what's left over. So the orange there is the S&P 500, and the black is what's left over. So outside the Seductive Six, all right, the S&P is actually down 5% this year. Right? So if you held the other 493 companies, you'd actually be down 5% for the year if you don't have those 6. All right? And so you're thinking, Chris, I'm confused because 500 minus 6 is 494, and you have 493 up there. You are stupid. So Google's actually counted twice because there's Google and then Google L, right? So it's actually 6 companies but 7 tickers. Right? And so you can see it's actually down. The Dow's down, as I mentioned. If you look at big cap versus small cap, well, of course, those 6 companies are the largest in the world. So S&P 500's on the top in blue. Mid cap, small caps, you can see are flat for the year. So the one thing I did predict was the stock market be up or down 5%. Well, outside 6 companies, I was kind of sort of right. But of course, that's like saying, like, if I got all the questions on the test right, I would have got 100. You can make statistics lie, right? All right, so, but anyway, I'm just saying that the market's been incredibly concentrated this year, right? It hasn't really been like a well-rounded market. All right, so, if you see me do this before, I do this all the time. I do NASDAQ exciting stocks divided by boring stocks. Last year, when the market came down, we kind of got back to a level that seemed right. Now we're back kind of where we were before in 2021 when tech was a little high. So is this the last breath, the last push for tech? All right, or are we just keeping a trend going that we have from 2013? Right, where tech is becoming a larger and larger part of the economy. All right, I think this is going to be the one big debate that we have coming up. Are we going to become a country like Korea where basically 3 companies are the entire economy? Or are we going to remain diversified, right? And that's a question that antitrust people are going to answer for, and they have no answer for. So probably it's going to keep going. All right, if you look at absolute stock valuation, it's still pretty high. Right, so it's pretty high. If you look at relative stock valuation, so if you think about bonds and stocks, they're in competition with each other, right? So of course, if I told you right now you could get 1,000,000% return on a bond that's risk-free, everyone would sell their stocks and buy the bond. And if I told you it was minus 1,000,000%, everyone would sell their bonds and buy stocks, right? So they're in competition here. So the blue line is the rate you get on the 10-year Treasury. The orange line is the earnings yield, so 1 divided by PE, basically. And you can see this is the first time in 20 years where bonds have had a higher yield than stocks, right? And so if you look at this, you could say, wow, bonds are a great investment relative to stocks. But if you look at back in time, for a long time, actually, bonds did have a higher yield than stocks, right? From like 1980 to 2000, bonds were on top of stocks, right? So this gets to my bigger question, right? Sorry, Steve. Are we going to be the last 20 years prior to COVID, or are we going even farther back in time? Because if it's the last 20 years, that implies one thing, right? That bonds are really cheap relative to stocks. If it's the other way, then it doesn't really look like there's a difference, right? It's probably both are fairly priced. And so this is the hard part to think about as an economist. All right, rates are way higher than they were before we could spell COVID, right? So if you go back to 2018, the 10-year was about 3%. Now it's about 5%, almost. It's down, 4.6 today, but it's still really high. All right, historically it's still pretty low, right? So rates here are still historically pretty low. So as much as Steve complained they're the highest they've been in 25 years, this is still historically pretty low for what we've had since World War II. The one thing I'll note about rates, which is really interesting, is inflation expectations for the next 10 years have not changed in 2.5 years. So if you went back 2.5 years ago and you asked financial markets, hey, what's the average CPI going to be for the next 10 years, they would tell you 2.5%. If you ask the market right now what's CPI going to be for the next 10 years, it would tell you 2.5%. So all the change in rates for the last 2.5 years has just been about real yields. It's about the orange line, right, where you went from a negative expected real yield. Now if you buy the 10-year Treasury or the 10-year tip, you can lock in a 2.5% real yield for the next 10 years, right, which is really the first time you've been able to do that in 20 years, right? In fact, I joke my best investment was because I wanted to go on a trip. So in 2001, you could still buy I-bonds with your credit card with no transaction fee. So I bought $30,000, because there's no limit back then, of I-bonds on my credit card, all right? And I did it by accident just so I get 30,000 miles to go on a trip. I locked in a 3% real yield by accident, and it's been my best investment I've ever made, right? And you can do it again over again, right? And so that's why I say bonds look relatively attractive here, right? I don't think real yields are going to stay this high for very long. All right, a couple of quick things, and I'm done, and Marshall's got a lot of great things to talk about. Housing market, it's kind of sort of like Top Gun Maverick, right? It's really not working. I would argue the housing market's just not functional at this point, right? We just don't have enough volume, right? It's just really not a market-clearing market. So if you take a $1 million house in Irvine, which is not even expensive anymore, if you got $200,000 for a down payment, that leaves you an $800,000 mortgage at 8%. Just your interest every month is $5,300 a month, right? Multiply that by 3, multiply that by 12. You have to make $200,000 as a family just to pay the interest on a $1 million house in Irvine, which is not even the median price. I haven't done principal. I haven't done insurance. I haven't done HOA. I haven't answered the phone. I haven't talked about anything else, right? So it's just not working, right? And if you look at housing affordability, it's the worst it's been in like 40 years, all right? It's the worst it's been in 40 years. So I'm not sure how the housing market fixes itself. This is going to be one of the big things that's very difficult to answer. All right, so putting it together here, just to finish, I think the hard thing for an economist is you're trying to figure out what's going to happen. And like I said, it's kind of sort of like we're back in 1960 or 1970, right? So you can choose, is it the year 2000, right? Which is when if you're old enough, you can remember when Conan was funny, all right? Conan's not here, is he? All right, good. All right, you got year 2000, or you got Lehman Brothers was still alive, all right? And you can think we're back then. If we're back then, you can imagine one thing would be true. Or if we're back in 1970s and everybody's ready to go to Woodstock, all right? Some of you might have been at Woodstock. All right, I've got good news for you for Woodstock. All the stuff you did there that was illegal is legal now. All right, so Woodstock right now happens in Aldridge Park every day, I think. The UCI table did not like that comment. So I'm going to rephrase it. Everything that happened at Woodstock happens at Chapman. Chapman. Yeah, it happens at Chapman. All right, and GM was the most valuable company in the world back in 1970. So the question is, where are we? Are we in 1970? Or are we in 2000? Because if it's 1970, it's one thing. If it's in 2000, it's another. So this is what I showed you before. I just showed you the stuff on the right from 2000. This is Fed funds minus CPI. All right? For the 50 years before 2000, right, Fed funds minus CPI had a real yield of 2%. So if you kept your money in your bank account for 50 years before 2000, on average each year you'd make 2% real return not spending any money, right? You are incentivized to keep your money in the bank, right? From 2000 to now, it's been zero, right? It's mostly been negative, sometimes it's positive, but it's averaged zero, right? And so what you want to do, depending on which reality you think you have, you want to make very different decisions. The 1970s, everybody knows what to do. We're going to sell our long-term bonds. We're going to buy a bunch of short-duration bonds because interest rates are going to go up. We're going to sell all of our stocks because 1970 was not a good time for the market. Real estate's going to struggle, and we want to buy some oil, right? If it's 2000, then we want to buy lots of long-term bonds. We want to lock in these real rates of return. We want to sell all of our stocks still. Real estate will be okay, struggle a little bit. We want to sell commodities. Right? So which one of these are is a very different answer, and it's kind of difficult to predict. I think really the biggest thing that we don't think about as economists, and I know you've heard me if I've said this before, I think if you look at demographics, it tells us it's 2000. Right? Because prior to the 50 years before that, we basically had 1.2% people growth in our economy every year that can work. By the way, this is incredibly understated because, of course, women entering the workforce was another huge driver of labor force expansion, which isn't here. So it's probably more like 3% per year. All right? And now we're basically at zero. Right? So our real potential in the economy is much lower than it was the prior 50 years to 2000. And if you think that real interest rates and real growth of the economy are related, that means we can't have a 2% yield. All right? We can't have a 2% real yield in this economy if we can only grow at 1.5% per year because everyone just put their money in the bank. Why bother investing in the economy? Right? You have to be incentivized to invest to grow the economy. Right? So demographics tell us it's 2000. But just in case I'm wrong, it's 1,350 degrees and surprise, all right? Or 2385, all right? So just in case I'm wrong, I don't even know where the hell, anybody know where this is? It's a surprise, it's in Arizona? I don't know, it's really hot there this summer. Maybe this is the actual temperature and they weren't wrong. All right. So the economy's still chugging along. Eventually we'll have a shock that causes recession. I think bonds look pretty good here. I don't think that the economy can do a 2-3% real yield long term. And again, my open question, which I don't have I feel like it's probably we're back in 2000 and not 1960, but that's really the way you want to view the economy, right? If you think it's 1960, you want to do one thing. If it's 2000, you do another. And I think just demographics and economic potential say it's 2000. So thank you all again for coming this year. Look forward to what you have to say, Marshall.
Thank you.
Thank you, Chris. All right, so let's move on to our second speaker. Marshall Toplansky is an award-winning innovation professor of management science at the Argyris School of Business and Economics at Chapman University. He's a research fellow at the Center for Demographics and Policy and is director of the school's Analytics Accelerator program. He and co-author Joel Kotkin recently published an economic and social policy brief entitled Nurturing California Industries. I think you can get that online. Can you see it online?
You can get it online.
Can see it online, which discusses the issues California faces in maintaining home ownership for the middle class and rebuilding a positive business climate. Marshall is also the co-host of the Feudal Future podcast, which is seen twice monthly by viewers around the world. Co-founder and former managing director of KPMG's National Center of Excellence in Data and Analytics, Marshall also co-founded the big data company Wise Window, a pioneer in analyzing social media, blogs, and news stories to track business trends and predict elections, which was acquired by KPMG in 2012. Marshall was chairman and CEO of Core Strategies, a technology, industry marketing research and strategy consulting firm, and formerly head of marketing for U.S. Robotics. He's earned an MBA from Harvard Business School and is director of the Harvard Business School Association of Orange County. In 2020, he was given a Global Humanitarian Award from CWS for his work with the organization addressing the global refugee crisis, which I think we'll probably be seeing a lot of that in the future.
Unfortunately.
Please welcome Marshall Toplansky.
Thank you, Steve. Thanks, Chris. And Chris, thank you for a really phenomenally interesting presentation. You know, I was particularly struck with the fact that your last open question really related to one's time frame. You know, and where do you really view yourself? Are you looking at the longer time frame? Are you looking for shorter time frames? Of course, economists have this unfortunate burden of having to predict next quarter's GDP, which is a tough burden, right? Because if you're focused on short-term things all the time, it doesn't give you the perspective that you really need. And so today I thought I would take us on a journey to the past a little bit. Steve asked me to put together some thoughts about what's really driving the real estate market here, especially the commercial real estate market. And I chose Southern California, but really it's, I think, much of California. And you really can't do that unless you put yourself in the right time frame. So think about this for a minute. You know, the Southern California commercial real estate world that we know, think about Fashion Island for a moment, which happens to be on the right, was created in roughly the early 60s through 1967 is actually when Fashion Island came about. Much of that came from the minds of just a couple of visionary architects. Welton Beckett, for instance, who was a big friend of Walt Disney, and William Pereira, designed most of the things that you look at Southern California today as kind of the hallmark of Southern California commercial real estate. On the left is the Music Center in Los Angeles. On the right is a view of Fashion Island. We have the iconic building at LAX that was a consortium of people, including Pereira and Beckett, the Capitol Records building, all the wonderful home savings buildings that you've seen around that still exist as probably not as home savings, unfortunately, but as something else. The vibe that era embodied was one of boundless growth. That's what we really thought of when we thought of Southern California, and what made it different from other areas of the rest of the country. California and Southern California was where the growth was. You know, and think about what were the demographic and economic factors that really brought that to the fore. Well, first of all, a lot of in-migration to California, largely from other parts of the United States, but also internationally. And in fact, that international in-migration continued, well, through the start of the Trump administration when it started to tail off. High fertility rates. We had people were having babies, right? This was the baby boom generation. I'm a baby boomer. My parents obviously got busy in the 1950s. There was an optimal mix, especially here in Southern California, of technology-based businesses. At that time, it was largely aerospace, not so much, we weren't at the digital economy, right? But this was aerospace and new technologies of the time, combined with the ability to make the stuff, right? So we had a robust manufacturing economy as well as a technology economy, and that created a really robust middle class here in Southern California. And we also had a lot of people forming businesses at that time. So from 1950 to, well, 2020, actually, California saw net migration throughout the state. All those green bars are people coming in from the bay to the border, southern border, even in the interior areas, which were the red areas, we were seeing a lot of growth. Look what happened in 2020. Off the charts, down. That environment changed dramatically in 2020. In my mind, this kind of signals a shift, and you were alluding to it because it's an open question. We don't know yet what the play out of this long-term trend is going to be, but I call it entropy. Orange County was built on putting together the infrastructure for a broader Southern California environment. We spent a ton of money in places like Irvine with planned communities, even a planned university, which has become a tremendous force in our economy and in our intellectual capital. But that's built already. We're now moving into a world where we're more into maintaining it than we are into growing it further. Population growth has slowed a lot, and it's even declined, and It will continue to do so. This chart has the projections that the state makes between 2020 and 2060 on population. It's the latest Department of Finance projections, which of course, who would have more accurate forecasts than the Department of Finance, right? Thank you, Katrina, for telling us that our sales tax was up. This is what they do, right? They figure out how much money is going to be coming into the till. As you can see, Orange County is not going to be seeing a lot of robust growth. And Los Angeles County is going to be seeing a dramatic drop of population, which has actually already started. We lost one House of Representatives seat in this past election because of the decline of population. So who's leaving? Who's going out? Is this a concern for us? Is it something that is just across the board? My data shows that we actually have a very serious question to deal with here, and that is that the people who are leaving today are quite different from the people who left even a decade ago. So if you can actually take out your super high-res glasses and see what is actually on those charts, hopefully you can, you'll notice that by the way, this data comes from the IRS, so it's as good as it gets in terms of looking at people who were filing a tax return in one state and now they're moving to another state. I just picked 2 random years. So in the 2011 to 2012 year, the bulk of the people that were leaving, and this is by age band, were younger people. Were older people. And if you look at the 2018 to 2019 circle on the right, you'll notice that actually it's not senior citizen older people, but working core prime earning age people that are leaving. If you do the same data on income, people without money were the ones that were leaving in 2011 and 2012, and the people with money are the ones that are leaving today. That's not good. I call that our seed corn, right? This is the group of people who we would normally build the next generation of growth on the backs of, and they're leaving. So there we go. Add to that the fact that fertility rates are dropping, and they are expected to drop globally. So this chart, there's a zillion charts that I could have given you on this. California is very typical in this trend as well. But this is the global fertility rate for the 6 regions of the world. Look at what's happening with those rates. Traditionally, places like North America and Western Europe have already seen a drop of population below the replacement level. The people that were having lots of children were places that either were agrarian economies in places like sub-Saharan Africa, or places where culturally children were considered capital. And for instance, Indian subcontinent. That is changing dramatically. China, for instance, is expected to lose half of its population between now and the end of the century. Here we are having similar issues, right, of dropping population. There was actually an article in today's Wall Street Journal talking about where states in the country that are actually becoming vacant, the way Japan has struggled with that same problem. So add to the fact that, okay, we're not replenishing the pool of people who would be the people that would be using our commercial real estate, using our malls, using our places like that. Add to that work preferences have changed. We've moved, this COVID thing, it's not at all clear yet how long-standing this is going to be. That was one of the issues that Chris brought up. But if you look at what people prefer, and especially what the younger working generation prefers as a work environment, it's a hybrid work environment. The numbers that I saw most recently showed that on an optimistic basis, we would be looking at 50% occupancy in commercial spaces. That's going to have profound effects on what the value of commercial real estate is all about. As Chris pointed out, high housing costs are making it really hard to move here to Southern California, despite the fact that we have plenty of job openings. This chart shows, we use median multiple as the number. I don't know how many of you track that number, but it's the percentage, it's the multiple of the income that is represented by the median price home, the multiple of median income that's represented by the median price house. We're talking about, in coastal California right here, 11 means that it takes 11 times the median income to afford the median priced house. Places like the Midwest, it's 3. Historically, in the United States, it's been in the 3 to 5 range. So we're talking about grossly unaffordable. You can move to the interior of California and maybe get it to a 7 if you move to Riverside or San Bernardino County or up near Fresno. But outside of California, you're looking at 4 or 5. This is one of the reasons why people are leaving the state, because they can't afford to live here anymore. And that has huge, profound effects on our own commercial real estate. So as a result, we're left, excuse me, with an aging population. If you look at these different charts, the 65 plus number in the bottom right, if you look at the dark blue line, is the only one of all the demographic cohorts that's actually growing. And this is data for the United States. When you look at the data for California and Southern California in particular, it's even more acute. We are aging. Now, is that a good thing or a bad thing? From a commercial real estate point of view, might not be such a bad thing, right? It could be that, for instance, healthcare facilities, specialty hospitals, facilities that help with things like physical therapy and other kinds of problems that old people from the Muppet Show like me end up having, as we kind of throw our bombs at everybody else, talk about how bad life is. This could be a good real estate opportunity for Southern California. And if you look at Orange County, we're actually, the market is saying, yeah, we kind of agree with you. We have City of Hope coming in. We have a ton of activity going on around Hogue to be able to provide extra services to people. In my neck of the woods in Chapman, we have a tremendous amount of growth going on around St. Joseph's Hospital. So there's a lot of activity that's happening in that area. It's reflecting the character of our aging population. So let's take a look at some of the shorter term data, because I told Steve that I would give you a quick Bedeker of different data around the real estate world. First, from an interest rate point of view, we've already heard from Chris. We know what's happening with interest rates. Beyond looking at the segments of the real estate market, high interest rate environment is going to put pressure on returns and hurdle rates for some time to come. Experts are not expecting a return to that low-cost money era that we saw. And by the way, I'd like to, the next few slides were put together by my incredibly great team from Chapman University's master's degree in real estate over here, sitting at this table. So thank you very much, Matt, and the team, Matt Leitner. Some great data. So let's look first at year-on-year rent growth for the office market. Not surprisingly, it's completely flat, right? The good news is it's completely flat. It's up from negative, where it was relatively recently. The chart on the right, if you can read through that, will tell you by sector where what the typical office rents are, what the difference is from a year ago. And we're looking roughly in that $2.50 per square foot monthly number. You can see what the net absorption is. You can see that the greater airport area has had the biggest negative absorption in the past year. So it shows you that it's relatively, it's hitting that strong Irvine, Newport Beach corridor hardest in terms of office vacancies. If we look at multifamily, sales and rent growth have stalled. It's expected to recover in 2024, but then again, you know, this is an area that economists have, you know, notoriously been, let's say there's a high degree of variance in what actually happens. You can see that that the COVID period hit the sales volume quite hard, and you can see what the market rent per unit is compared to the U.S., and you can see that it's, you know, it's been on the rise a little bit, forecasted to continue to go as inflation continues, but we really don't know, right? We don't know what the impact of interest rates are going to be in this particular segment. Retail has actually been relatively steady, with the exception of some strip malls and strip centers and power centers. Retail vacancies have been relatively stable over the course of the past few years, even during COVID. Probably the biggest bright spot in commercial real estate has been the industrial and distribution sector. Lots and lots of growth. You see, if you go up the 55 toward where we live in Chapman University, you'll see a lot of new distribution centers that have gone up for Amazon, for other kinds of businesses. The vacancy rates have dropped dramatically during that same time period. So this is an area that historic, or within the most recent past, has been very, very strong. It's not at all clear whether or not we've now reached a peak, whether or not the amount of space that is going to be required to be built is going to increase. But the good news is, at the moment, we're doing pretty well in that department. So the big questions that I have for the future, and my time frame is a very long time frame, because I think commercial real estate is a long time frame business. Real estate in general is a long time frame business compared to economic forecasting for the next quarter. I look out over the next 20 or 100 years. So I see three worry beads, somewhat mimicking what you were talking about, Chris. First is fertility and birth rates continue to drop. I just saw some new population estimates of what the world population is going to be in the year 2200. Which seems like, you know, I'm not going to be around then. All of you, of course, will be, because you're in such good shape, and you're living here in Southern California, so you're going to be working out. So you'll be around for the year 2200. 2100 is expected to be the peak of global population in the world of about 10.5 billion people. The numbers for 2200 range between 6 billion and 2 billion. And that's without any of the climate-adjusted alarmism that you would factor into a forecast like that, just extrapolating out birth rates across the world, across the planet. So what does that really mean in terms of who's going to be here? To me, the biggest issue is going to be immigration policy. Because how else, if we're not making babies and we don't have people, you know, growing their own population, in order to be able to take the jobs that we're looking to be able to grow or even maintain the economy, we're going to need workers. Today, we're worried about a big flood of immigrants coming in at the border. By 2123, 100 years from now, we may have to beg people to come, right, in order to be able to maintain any semblance of growth. Come here. Good news, we're Orange County, we're Newport Beach. Where else would you come? If you had to pick any place in the world, why not pick here? This is the best place on the planet. So, but it's a big issue for immigration policy that we have not really put our heads around in any kind of systemic way. And the last question is artificial intelligence. Not just ChatGPT, which is kind of a fun little, you know, sidebar thing, which, by the way, what I do with my students is I say to them, I want you to use ChatGPT. In fact, here's my exam question. Here's what ChatGPT says you should use. If I see this on your test, it's an automatic flunk. You need to figure out what's wrong with the answer from ChatGPT. But, you know, artificial intelligence is far more than ChatGPT. It is really automating every operational process in the world to be able to have computers do predictive and prescriptive analytics to be able to say, okay, based on the trends that I'm seeing, here's what the right optimal answer is. Well, what does that mean for humans? What does that mean for the thousands and thousands of people who we employ today to be able to use some form of judgment to be able to make decisions, even as routine as do you get a loan or not from a bank? That's a huge worry. And if those jobs go away, what's going to be left? The maintenance, probably the maintenance of our physical infrastructure. So if you have, you're from UCI, I'm from Chapman. We both make our living trying to broaden the minds of our students to be able to prepare them to be leaders for the future. I wonder whether or not we should be saying, be a welder, be a carpenter, be somebody, be a plumber, be an HVAC engineer, somebody who actually has to do the business of maintaining the physical infrastructure of our world. That's not going to go away, and that's not going to be outsourceable from AI. So that's where I think are the questions are for the future. Thanks for listening. Thanks.
Okay. Thank you, Marshall. So we still have a little bit of time here for some Q&A. I believe we have a microphone out in the audience, so if you're interested in asking a question, raise your hand and someone will come over. I'm going to kick off here, though, Marshall. I'm going to not let you get off so easy. And so looking at the commercial real estate markets, and I'm talking about office, industrial, retail, and maybe even multifamily. Those four sectors, what's your prediction, let's say for the next 5 years, if someone was looking to invest in those types of properties?
Well, I think there would be two areas for me that would be strong. One would be, but they're specialty things in a sense. One is rethinking multifamily to make it more senior friendly. Today, most of the product that's been built really is not designed for seniors with accessibility issues. It's been designed for younger people. So I think there's a huge opportunity to take older projects and retool them. Second thing for senior people. The other is I do believe that this healthcare trend is going to continue. And so being able to invest in doctor's offices, specialty surgery centers, specialty healthcare-related real estate will be a huge opportunity. Retail, retail is going to be steady. I think it's going to be very experientially oriented because I think that the key changes that we've seen in retail is that a lot of the commodity-oriented retail is going toward online. And so things that involve experiences that people would be, fully immersed in will be really good. Office is a huge worry bead in my mind. I have no idea of where that's going, whether or not employers who insist upon people coming back into the office will actually be successful or not. My betting is no, actually. So to me, it's not something that I would put my money in. And industrial, I think, is going to be a math problem. What is you need to look at what the capacity is for the logistics and for the, not heavy manufacturing, certainly in this area, but light manufacturing, but more distribution, right? What is the capacity that these companies have to deal with, and how much more additions to capacity are they going to need? That's how you're going to figure out what the opportunity is. And it's going to be patchy in terms of where you site things, because the cost of energy is high. People are going to want to minimize the cost of trucking and cost of gas.
Okay, thank you. Do we have a question out there, right there? Anybody? Questions over here?
I'll give this one to the smart aleck dude from UCI, the anteater guy.
Smart aleck dude.
You're funny, I like you.
You're funny
Wish I
looking,
would
I
have had
like
you in
you.
class, man. Maybe I would have gone to school. But the
What do you got?
national debt now is 33 trillion and growing every month, and it's a big train wreck. The interest on it is astronomical, larger than the defense budget or something of that nature. So where's that going to take us? It's just deadly for inflation. Where's it going to go?
So just putting out a number in nominal terms for debt is like telling me that I have to afford Bill Gates' mortgage, right? So, our debt relative to other G20 countries is probably at the median. At 33 trillion and a $30 trillion economy, we're pretty much at 1/1, which is, we're probably ranked 11th out of 20 G20 countries, right? So, in terms of where we are, I think we're fine. I mean, I think we have, I think we do have some fiscal issues, but I don't think they're binding. I think a lot of the stuff that's going on right now, as you saw in my graph, it's all about real rates, right? It's not about inflation or people worried about Fed financing deficits. This is just simply Fed-driven interest rate policy right now. And so, I mean, if we're going to start talking about debt, let's talk about Japan's. They're at 4-1, and their interest rates are going up a lot. They're in much worse trouble. But I got good news for everybody in the room. No country has ever successfully paid off its national debt, and we will not be the first. So I think, it's just something people worry about, and it's something I don't lose it. Let's put it this way: when the U.S. government can't pay its deficit anymore, then we got a lot of things to worry about. So I don't think we're there yet.
Okay, another question? Back there, up here? While you're making your way over, I have another question. So over the last year, we saw some bank failures, a lot of it related to real estate loans. And, obviously interest rates are very high, mortgage rates are high, but even commercial rates are high. I just saw a building, passed through my email, they were asking like $60 a square foot for an office building up in Los Angeles. So obviously a lot of owners of commercial real estate, and especially office properties, as you alluded to, are going to have a problem because their loans are coming due. Their buildings are half full if they're lucky, and their interest rates are going to more than double. So is this a commercial real estate developer problem, or is this a bank problem? And I'll let either of you answer that.
I mean, if history is any any guide, we'll have some kind of version of the TARP program probably.
Right.
We'll probably call it the CRAP program, the Commercial Real Estate Assistance Program.
Right.
To help them out. That's my guess. So.
Yeah. This is the market writing itself. There's nothing here that's nothing here that we haven't seen before in the past, and this is it's going to be. I think it's going to be a big opportunity for speculators who want to buy cheap. And I think it's going to be a really difficult time for the banks, because the question really is, at the higher interest rate level, what number makes sense?
Exactly.
Right? And if if you developed the project in Los Angeles with with 2% or 3% money, and now in order to refi it, you're going to need to come in at 8% money. That's who's going to rent? So that's a very tough. That's going to be a tough one.
So would you expect any bank failures out of this going forward in the next couple of years, or you think the market will figure it out?
I think the market will figure it out, and I think that the Fed has done or the Office of Comptroller of the Currency has done a great job of trying to bolster equity in banks to try to anticipate something exactly like this. And so unlike the highly leveraged situation in 2007 and 8, I think we have a little more wiggle room there for the banks.
I mean, also the interest rates, if you think about timeline, it's a variety of maturity dates. It's not kind of like the housing bubble, all of them happening at one time, and it caused huge failure rates. So there's some ability to spread it over time.
Great. Was there someone have a question out there?
My question was on the same topic, and that was the debt, commercial real estate debt bubble, but I'm glad to hear it's being solved by CRAP.
Well, I think Chris's point, if I can reinforce your point a little bit and maybe get you to expand on it, we tend to think, because of the huge number, we tend to get kind of gun shy about this whole debt thing. But when you look at it as a percentage of GDP, we're not as over leveraged as a lot of other places, right? And so you know, if you start looking at the core tenets of the currency and global economic system, you could argue, well, why does anybody have faith in a government, right, to borrow all this amount of money? Well, they have the faith because they know there's an endless amount of tax revenue that can be generated. So I'm actually on Chris's side. While it's kind of appalling or shocking, put it that way, when you look at the gross number, in context, it's not as bad as you might think.
Okay. Is there another question? All right, I'm going to ask the last question. Something that, I mean, we used to talk about it a lot. I haven't heard much about it this year other than in maybe the war context, is China. Where's China?
They're in trouble.
Yeah, big time.
Because?
Demographics, they're screwed.
They are. Well,
I mean-
look, you have 1 billion people that have, you know, take the big picture, right? The country made its bones becoming the world's manufacturer.
Everyone's expensive and everyone's leaving, and the median GDP is 1/5 of the US. It's still a relatively poor country, and they're out of people.
And,
It's like-
and they never really, they never invested in automation to be able to keep the assembly lines going, right? To keep the factories going, because they wanted full employment. And so guess what? They're just now competitively at a tremendous disadvantage. And when you cut back, then you add in the real estate bubble that has now burst, which makes them incredibly indebted to bondholders that are going to lose a ton of money. They're going to be kind of radioactive.
And their demographics are terrible. They're like a more horrific Japan 1990.
You know, you're 1 billion people today and 500 million people 50, 70 years from now. Oh my God, that's not good.
I mean, their working age population is already going down, and they've had a one-child policy for 30 years, so it's now just binding. And now they want people to have kids, but nobody wants to have kids in Shanghai. It's like, I'm in New York every week. How many kids do you want to take on a subway in New York?
Well,
Pretty much zero. I'm glad my kids are there.
Right, exactly.
Right? So, you know, they can't even get people to have kids. It's like why they have Procreation Day in Russia, to try and get people to have kids. So,
well, and add one more element to
That
it.
could be a new chamber event, Procreation Day. I like that.
Add one more element to it, which
Stay
is
away
that
from that.
the kids that they did have, they spent a ton of money educating. By the way, thank you, UCI, for educating a great percentage of those people.
stay away from that one, too.
They don't want to work in a factory, and there aren't enough jobs for them to do that would be commensurate with the kind of education that they had. So you have a workforce participation problem. That is a massive problem. We have a little bit of it here, but they have a lot of it there.
I'm going to just go with they're screwed.
Yeah,
Screwed?
they're
Okay.
screwed.
Stick with that.
You heard it here, folks. We'll see if, next year I'm going to bring this up and we'll see if you have the same opinion.
Steve, do we have time for one final question?
Oh, sure.
One final?
Love to. Yeah.
Hello. My question is about onshoring of jobs for manufacturing. Do you guys predict or see a pretty strong movement of bringing things back to America and actually making more stuff here?
I doubt it.
Yeah.
I mean, there's a bunch of problems. I mean, number one, we don't have the people to do it, right? Number two, I think this gets back to Marshall's point where, you know, people don't want to work in a factory all the time. It's not exactly, you know, a traditional factory. It's not the best thing. I think the third one is, you know, the reason that, you know, Foxconn and other places work in, I'm going to call it places like China, is because they can hire 400,000 people and get rid of 400,000 people in a month. Right, so they can meet that iPhone demand cycle, and just based on our unemployment insurance and our onboarding and all that kind of stuff, you just can't do that here. So I think there'll be diversification of supply chain. I think that is definitely happening, but I don't think that's really going to make jobs come back to the U.S. So on the manufacturing side, I mean maybe some, but it's going to be like very high, like you see like kind of like semiconductor manufacturing, and a lot of that's actually driven by you know, security concerns more than anything.
Right. Well, and also it depends on your definition of here. So in the United States, if you're looking at it from a national perspective, I agree with Chris. There'll be some things that will strategically be brought in, and this is what the whole Ohio chip thing is all about. But if we're talking about California, right, and restoring some middle-class balance to our own economy, no way. The environmental regulations, the CEQA endless litigious environment will make this impossible for California to benefit from this kind of reshoring, even if it turns into something.
Well, certainly, the biggest complaint that I get as a chamber president and hearing from my businesses, members, is government regulation. It's really just killing the economy here. I mean, I'm an attorney by trade, and I only have a staff of 4, and I can't keep up with it all. You know, the HR, all the ADA, all the regulations, and I know many of you have the same challenges that I do. So certainly demographics is important, but even, you know, just the climate here in California is getting more and more difficult. I mean, they just signed a bunch of bills up in Sacramento to, you know, increase the amount of sick days. I think fast food workers are now going to get $20 an hour if you're part of a chain that's 60 or more. So, you know, costs of doing business here in California are going up, and it's not going to be a welcoming environment, certainly for these factories or other businesses that want to create here. Barring that, though, we do have great weather, and I'm not leaving either. So that's our forecast. Hopefully, if you learned something today that you can take back to your place of employment. I know a lot of you are working on budgets and things for 2024. I do want to take 1 minute to thank our sponsors and Leadership Circle members, the Balboa Bay Resort, for the meal today and the service, my staff at the Chamber for putting this all together, and certainly all of you in attendance. I think you were the smart ones to hang out because the valet was probably pretty crowded a few minutes ago. And just remember, if you're not a member of the Newport Beach Chamber of Commerce, you should be. See me and I'll sign you up. Thank you for coming. We'll see you next year.